We are living through the worst economy that almost anybody alive has ever seen.
Hey, what's up, guys? Market seems to go up, but at what cost? In this video, we will look at one of the most promising metric which indicates that market is extremely overvalued. Then, legendary investor Howard Marks will give his own opinion about our current economy. First, let's take a look what is going on with the market. S&P 500, after dropping 35% within just 4 weeks, was able to recover some of those losses. At the bottom, the price was at $2,200, and as of today, it's around $2,955. That's a 35% increase from the bottom to the top, but it still did not reach its all-time high where it was back in February. Right now, that index is forming some sort of logarithmic patterns. Instead of seeing V-shape or U-shape recovery as many investors have predicted, we kind of seen something like L-shape with the end being tilted in reverse. The only way we are seeing this recovery is because Fed injected trillions of dollars into the market. Apparently buying treasuries was not enough, and now they're buying corporate debt to inject even more money into the market and even faster. Only time will show what will really happen for the next few months, but over the next few years, there is a good reason to believe why market might be lower compared to today's levels. Now, let's take a look at the cyclical adjusted price to earning ratio or CAP ratio of the market. This is one of the standard metrics used to evaluate whether the market is overvalued, undervalued, or fairly valued. This metric was developed by Robert Shiller and popularized during the dot-com bubble when he argued that equities were highly overvalued. For that reason, it's also casually referred as a Shiller PE. It's mostly commonly applied to S&P 500, but can be applied to any other stock index. CAP is a bit harder to calculate than just a normal PE ratio, as normal PE ratio can be simply calculated as follows. We simply take the current price and divide that number by earnings of a year or a quarter, depends what you want to calculate. The CAP is more reliable metrics as it takes entire cycle of the market. The CAP for 10 years is calculated as follows. Take annual EPS of S&P 500 for the past 10 years, take the average of those real earnings figures for the past 10-year period, divide the current price of S&P 500 by the 10-year average EPS number to get CAP ratio. That is 2,955 divided by 83 plus 96 plus 96 plus 104 plus 116 plus 100 plus 106 plus 124 plus 140 plus 160 and divide by 10 equals to 2,955 divided by 1,080 divided by 10 equals to 2,955 divided by 1 of 8 equals to 27. Now, what does that mean? Fair value for an average ratio of the index is at around 14. If the ratio is between 7 and 14, it means that market is undervalued. On the other hand, if the ratio is between 14 and 20, it means that market is overvalued. If the ratio is at 20 and above, it means that market is in bubble territory. Right now, the current ratio is at 27, which means the market is in hyperbubble territory. What does that mean for you as an investor? Should you invest now? Well, I'm not going to give anyone financial advice, but according to the CAP ratio, it means there is a high probability that for next 10 years, we might see suppressed earnings. A reversion to the mean is a serious force, and I won't be surprised if we see the CAP ratio under 20 and even lower. Let's take a look what legendary investor Howard Marks has to say about our current economy.
What do you think? Can you fight the Fed?
I think that the Fed has great power, but not forever. And I think that, first of all, I don't think it really, Jay Powell talked about the Fed will not have the ability to run out of ammunition. I don't know if the Fed's ammunition is really limitless. I know that the Fed can cause markets to rise and stay up as long as it buys. But I don't know if it can buy forever. We're in new territory here. Historically, the Fed has never bought corporate securities. This time around, they included corporate securities, and then they moved on to include non-investment grade corporate securities. Its buying can make these things rise, but only as long as it's buying. I think of it as kind of, we've seen these things where there's kind of a column of water and then a ball sitting on top of the water. And as long as the water's forced up, the ball stays there. Water stops, ball falls down to earth. So obviously the Fed hopes that its buying will, among other things, inject confidence into people and that they'll take over in buying. But that remains to be seen, and it remains to be seen whether that buying will be at today's levels.
Is there any reason, Howard, to expect that's going to happen? Let's just talk about the corporate bond market, but use as an analogy the 10 years that followed the financial crisis. We had QE1, 2, 3, and every time the Fed tried to pull liquidity out of the market, it seemed, investors rebelled. There was the taper tantrum. There was the fourth quarter of 2018 and other instances. Yes. Are you suggesting that the moment the Fed tries to withdraw liquidity from a market that really prices itself on solvency more than anything else, the same thing's going to happen?
I think it has to happen to some extent. This is the dilemma. Can the Fed keep it up forever? And if it doesn't keep it up forever, will prices weaken? I mean, those of us in the markets believe that stocks and bonds as well are selling at prices that they wouldn't sell at if the Fed were not the dominant force, at prices that would be determined by just the outlook for the companies. And so, number one, if the Fed were to recede, we would all take over as buyers, but I don't think at these levels. And you mentioned the difficulty of withdrawing the support. I personally believe that there is too much concern with the downside of withdrawing the support and not enough concern with the downside of never withdrawing the support. And I think that if it had been done earlier and gradually, it could have been done. And as you say, there was a bit of a temper tantrum in the fourth quarter of 18 when the interest rate on the 10-year Treasury reached 3.25. I think that was October 4th. And the market started to go down from there. So, of course, kids like candy and investors like low rates, but we have to have discipline also.
Fed indeed has a great power, but not forever. Fed's ammunition is limited. One monetary stimulant is already out of the window. That is 0% interest rates. Another monetary stimulant is printing money. Fed's printing press goes brrr, brrr, non-stop. Actually, it sounds like my cat. But they have to be very careful with that printer, otherwise we might end up as Venezuela with their hyperinflation. I like Howard's Mark analogy where he explains current economic situation. Think of the Fed stimulates the market as a column of water with the floating ball on top. As long as the water forced up, the ball stays there. But if water stops, balls falls down on earth.
Howard, you quoted a most memorable line in one of your recent memos. Capitalism without bankruptcy is like Catholicism without hell. It really is an incredible line.
Yeah. And I didn't make it up.
No, I'm aware. You said it's been variously attributed. I guess my question around that is, if in fact there aren't as many bankruptcies this time around because of the fact that the Fed and, I should add, the Treasury Department are doing everything they possibly can to support the economy. And if in fact there's less of what we might call a distressed cycle
Right.
as a result of that, what are the consequences? First of all,
Well-
do you agree that it appears as though it's not a matter of agreeing. Does it appear to you as that there will be less of a distress cycle? And if there is less of one, what are the consequences?
Well, you didn't finish your sentence, Eric, because you said, do you agree that there would be less of a distress cycle? And you have to say less than what? Less than usual?
Yes, I
Less
suppose.
or less than there otherwise would have been? You know, you have to finish that
Right.
sentence.
Right. No. So let's go with that as the premise. Yes. Less than normal, less than there would have been, less than the global financial crisis, less than whatever you choose to use as a comparison.
We are living through the worst economy that almost anybody alive has ever seen. You have to be over 80 years old to go back to the 30s to have seen worse, and maybe we're even worse than that. It's believed that the unemployment rate will hit a higher level than was achieved in the Great Depression. People are talking about second quarter GDP being down 30 to 40%. As far as we know, I mean, there aren't good quarterly records, but as far as we know, there's never been a quarterly decline in GDP to that extent. So we're in the worst economic environment, let's say ever. And you would think that that would bring on the greatest distress ever. It may not happen because of the Fed and government action. I think we'll still have a very substantial distress episode. You know, in 1991 and in 01-02, we had 2 years of 10% defaults in the high yield bond universe. We may have 20% defaults in high yield bonds anyway. And there are still lots of highly levered companies and highly levered investment entities that desperately need large amounts of cash to avoid a meltdown. And, you know, some of them will not get what they need and some will melt down. The other thing I want to mention, though, is the impact on society, because there is a concept called moral hazard. And moral hazard is when people who engage in risky behavior and bad things happen, which could cause them to pay for their risky behavior, are supported and sheltered from the risky behavior. And that's the importance of the quote about hell. In order for business and investment to function as it should, there has to be a fear factor. I am afraid of losing money for my clients. That causes me to be conservative, and that has shaped my career. And you know, my Oaktree colleagues, Bruce Karsh, my partner, we both embody this conservatism, and it has caused us to stay high in the capital structure and try to invest in companies which have better futures, even if they are financially distressed. When people are not afraid, when people believe that they can engage in risky financial practices and will be sheltered from the impact, that creates a risk-prone aspect of society, which I believe is not desirable for economies and companies and markets.
Capitalism without bankruptcy is like religion without hell. Are we living in capitalism, or only there is a capitalistic gains during the bull market and socialistic losses during the bear market? This is exactly what happened during 2008 housing bubble. Banks were making money until they got in trouble. When they got in trouble, Fed was there to save the day. Let me know what do you guys think about Howard Marks and his economic outlook. Leave your thoughts in the comment section below. Hit that like button and subscribe.